Hello and welcome to BQ Prime. I'm T Bijoy Idicheriah, and you are joining us for this special conversation with Shailendra Jhingan, the Managing Director of ICICI Securities Primary Dealership. Jhingan is a money markets veteran with an experience spanning 24 years across top domestic and global financial institutions, and he joins us today to discuss the implications of the budget presented by Finance Minister Nirmala Sitharaman on Wednesday. Great to have you with us today.
Thank you, Bijoy. Thanks for having me.
Sure. Before we do a deep dive into the numbers, what were your takeaways from the macro perspective from this budget that was presented?
So, my initial thoughts are that, the budget kind of achieved everything which one was looking for. Which sometimes you would feel that there are contradictory objectives, but the budget, kind of achieved almost everything, and there's everything for everyone. So, from a macro practitioner, there is fiscal consolidation, and we are definitely moving towards the 4.5% target, which the finance minister has set out for FY 25-26. So, along with that, the budget assumptions all seem fairly reasonable. The tax buoyancy assumptions and the revenue assumptions all are in line. There has been an increase in the capex, which is extremely welcome, given that still the economy is not out of the woods in a post-pandemic world, and all that has been achieved by cutting on revenue expenditure and particularly the subsidy spending. So the 0.7% increase in capex as a percentage of GDP has been achieved by cutting the subsidy bill by a similar amount as a percentage of GDP. So that's extremely welcome. Just to give a context, the government's till FY 1920, the government consumption expenditure was something close to 70% of the overall expenditure. And as per the budget estimates for FY 24, this number is close to 50%. So that's quite a substantial, shift in the spending pattern which is happening. Now, one could have doubts on, whether this kind of compression is achievable in 1 year, because even last year it was close to 60% and we are coming down to 50. So that is something we'll have to see. But the point is that directionally the budget is right, and it's going, it's taking the economy in the right direction, and that is welcome. And plus, of course, there are other aspects like, the cut in the personal income tax rates. So there is a bit of a feel good. The stock markets were, looking at the budget with trepidation in terms of the capital gains tax, and nothing much has been, nothing has happened on that. So, there is everything for everyone in the budget.
Thank you. Since you already mentioned the fiscal deficit, why don't we immediately dive into that number? FY 24 fiscal deficit estimate of 5.9, along with the market borrowing numbers that have come out. What is your reading on these numbers, and considering the GDP and inflation estimates that have been used for these kind of projections, what is your sense on these numbers?
So, prima facie, given that the budget assumes a 10.5% nominal GDP growth, it seems consistent with the economic survey estimate of 6.5% real GDP growth, and one could assume a 4% deflator or inflation, which is assumed in the nominal GDP numbers. But having said that, we know that there is a downside risk to these estimates in terms of growth. For one, I would think that we would be lucky if we get even something like a 5.5% GDP growth next year, because the global headwinds are extremely strong. We have seen the way, the data is plummeting across the developed countries. The growth numbers are coming down. And I think there is a fair chance of all the monetary tightening which has happened in the last year with a lag leading to a significant slowdown, if not an outright recession in most of the developed countries. So in that kind of a global setting, getting to a 6.5% GDP growth number seems a little daunting. So, in terms of, I don't have any doubts about the intention. A 10.5 number seems reasonable, but I think as the year goes along, we might see some downside risk emerging there, and there could be some impact on the tax revenue growth numbers which have been assumed in the budget. But it won't be very significant. It's not something which is, it's not of the magnitude of 1% of GDP or anything like that. It will be probably be more like 0.3, 0.4% kind of a slippage in the overall tax revenues. And we know that there are some buffers which are there. One is that, last year, the kind of FX sales which RBI has done, I think the potential for RBI dividend is significantly more than what has been assumed. So, so from that perspective, the budget numbers seem reasonable. And I think we are moving to a glide path of fiscal consolidation, which is welcome. Uh, the the share of net market borrowing, compared to the overall fiscal deficit is lower. So, the worry for the market was that the borrowing number will be closest to 16 trillion, the gross borrowing program, and it's come at 15.4, and it's largely been achieved because the share of net market borrowing as a percentage of fiscal deficit is only 65 or 66% compared to the 70-75 it has been in the past. Now, that is essentially coming from the fact that government is relying very heavily on small savings as a source of financing the fiscal deficit. So there's a new scheme which has been introduced for women where, 2-year deposits are going to fetch 7.5%. Of course, there is a cap on the limit. So, and plus the limits on certain products like monthly income scheme, etc., has been doubled. So the point is that it is achievable. The small saving targets are high, but they're achievable. But it will come at a cost for the fixed income market in the form of very high deposit rates. Because it's very clear that if government has to mobilize this kind of small saving, they will have to keep, raising the small saving rates, and that is surely going to have a bearing on bank deposit mobilization. And we know that the credit offtake has been strong and deposits have been lagging. So there is anyway pressure on banks to mobilize resources, and that is going to have some kind of a dampening effect on on the GSEC market, on the kind of liquidity we see in the market. Come to think of it, there is a 2-year deposit in small savings which is giving 7.5%, but the 10-year GSEC is at 7.25. So there is a bit of an anomaly there, and I don't know. If let's say banks are today raising 1-year CDs at 7.75, even 8% at times. I think the demand from the banks is going to be a challenge going into the next year. So this year, although the borrowing number was fairly high, and initially, at the beginning in April 22, for instance, everyone thought that yields are going to go a lot higher, but there was very strong liquidity. There was very strong demand from insurance companies, because of some of their guaranteed products getting a lot of inflows. But again, that is something which has been which is going to get dampened in the current year because of the budget provisions. Sure. That non-ULIP, products are going to have a cap of 5 lakhs. So a lot of HNI money, which was going into insurance products, which was leading to very strong demand for long bonds, is going to, come down.
Yeah. I'm going to touch upon the liquidity point that you raised later in the conversation. But considering we have seen global central banks continuing to raise rates, are you confident that the borrowing will go through smoothly? Investor appetite will be there for the borrowing in FY24?
So I think the initial reaction of the bond market was positive. We saw that the 10-year GSEC, which was trading close to 740, before the budget came down to 727, 28 yesterday. So, and that was, I think, driven more by, a pure event based call that, people were expecting a 16 trillion number and it came at 15.4. So there was a positive surprise there, and that kind of, led to the rally. But I think overall, in terms of demand supply, I see next year to be a little challenging. I think there were few good things which happened this year. One is that, states didn't borrow that much. We have seen almost a 2 trillion lower borrowing, coming from states compared to what was expected at the beginning of the financial year. So I think that has been a big, saving grace as far as bond markets are concerned. I don't think we can expect that to continue year after year. I think next year, if the tax growth of states slows down, then there could be some challenges in terms of their borrowings, etc., and that might again start crowding out, the other segments, including GSEC, for that matter. So I think prima facie, I think next year is going to be a little daunting. Plus the fact that markets have been absorbing a lot of supply of 30, 40-year G6. The auction sizes have been very large, 9,000 crores per week, but it's been going through. But it's largely been because of the kind of mobilization which the FRA products or the forward rate agreement products have been receiving from the insurance companies, because the guaranteed products were tax free and they were giving very high post tax returns. There was very strong mobilization. Next year that's going to get challenged. So I think there will have to be a bit of a tinkering in the way the government supplies the bonds next year. I mean the segment towards
Any
the
sense
long
on how the calendar will look?
Yeah, so I think about we are looking at a average weekly supply of close to 35,000 crores in the first half. Given that let's assume 60% of the 15.4 trillion supply comes in the first half. That gives you approximately 35,000 kind of 34 to 35,000 kind of a weekly supply. In that, we think that the stress will be more on the belly of the curve. So the auction size in the 10-year, will probably have to be a little higher, because long end supply will need to come down, given that the insurance flows are going to slow down into the next year. And I think the 5-year and the 7-year segment supply could remain the same. Of course, there will be new instruments like green bond, where probably the government will look at slightly higher amounts than what we saw in the current financial year. Plus, there could be other instruments which could be looked at, including inflation index bonds or other products. Although we still don't think that the market is ready for a product like that. In terms of the floating rate bonds, I think the cost to the government will be very high. So I think my sense is that the government might try to avoid it, because 6-month T-bills are at 690. Plus, for a 5-year floating rate bond, the spread is about 100 basis points. So you're talking about a yield of 790 compared to a government being able to issue a 5-year fixed rate bond at 710. So there's no reason to look at floating rate assets. Plus, I think intuitively what we hear from some of the banks is that anyway, with benchmark lending, mostly on the asset side of their balance sheet, increasing as a proportion of the overall loan. So in many cases, in the case of private sector banks, almost 60-70% of the loan book today is floating. So there is no inherent need on the balance sheet on the asset side for another floating rate asset. So I think intuitively, I think banks are shunning the FRB as an asset. So maybe next year also it will be difficult to issue floating rate bonds. So I think the reliance will be more on the belly of the curve is the sense we have, which is 10 to 14-year bonds will be in higher supply.
Thank you. I was about to tell you to specify what you meant by the belly of the curve.
Yes.
Some of our viewers may not understand that terminology. But going back to the green bond thing, you still expect them to issue green bonds this year, even though there's no specific mention, because I think last year was an inaugural year, so they mentioned it. You still expect issuances then?
Absolutely. I think there will be more appetite. I think what's happened is that the sovereign investors who are who look at green bonds and ESG kind of investing, I mean they still haven't been registered in India. Some of those funds. So I think by next year we'll find that a lot more of those funds are registered in India, and that should help in terms of pushing through greater supply of green bonds. Of course, the greenium or the premium of green bonds, as the technical word goes, was about 7-8 basis points in this auction. Now that might come down to a few basis points, maybe 2-3 basis points as the supply increases. But there will surely be a greenium, which will be there.
Sure. In the past, the government had spoken about inclusion of Indian sovereign bonds in global indices. There's no fresh mention in this budget. We know there is a review process that happens every year, every 6 months like that. Do you think this means that the process to attract a new set of global investors into the Indian gilts market is unlikely to happen this year because the government is very clear they don't want to move on the tax side?
I think the government is clear, absolutely clear that we are not going to give tax incentives to foreign investors, which are much more than what we are giving to the domestic investors. So I think once that philosophy is clear, then these are the tax rates. We have opened up the bonds. There are far securities or what are called freely accessible route for FPIs. That is available in plenty. So if you want to come, there are bonds available. There are no restrictions. Now, I think the only challenge I see is in terms of some of the operational issues. I think the tax issue, even the FPI investors are clear that it's nothing is going to happen, because I think there's a fundamental view which the government has taken, and which is absolutely right. I think where the changes need to happen are more in terms of the rules and regulations regarding the entry, in terms of firstly the registration of FPIs, because that's still a very time consuming kind of a process. Secondly, I think one big issue which most of the FPIs face is that when they sell, and suppose you have to redeem in T+2, many a times the tax certificates are not available. So we could look at a much easier solution, say that you keep 5 or 10% in India for the tax purpose, because the tax in fixed income, the tax is not so high, because the entire 100 is invested, and it's only on the capital gains part or on the withholding tax on interest. So it cannot be a very significant amount. So hold back 5% of the amount and allow us to remit the remaining 95 immediately, so that we can meet the redemptions. So I think these are the kind of things which if the custodians and RBI and the government work on, I think these are the easier reforms, and that will still facilitate FPIs coming into India, and a lot of them will be okay with index inclusion if some of these things are go through. So incidentally, the decision is not with the government or RBI, it is with the index providers. And I think whatever needs to be done from our side has been done. Now, I guess it is on those people to take a call on this.
Sure. Yeah. Earlier in the conversation, you mentioned almost decadal high credit growth, while deposit growth has lagged. We are also seeing RBI moving into two-sided active liquidity management. So keeping all these factors in mind, and as we move into the busy season for credit, which means a further rise in credit demand, where do you see the benchmark 10-year bond yields move towards ahead of this policy that's a week from now, and as we move to the end of this financial year?
So I think broadly yields remain contained in a 720, 740 kind of a range. Every time the market touches 727 quarter levels, we see that the big banks have been booking profits, and they've been taking some of the bets off the table, particularly because they were very actively buying securities at 7.5, 760 levels. So I think the downside in yields is also fairly limited. The 1-year T-bill is already at 7%, and RBI is still hiking rates. I think in the 8th February policy, we'll get another final 25 basis point hike. And unless, there is a view which emerges that Reserve Bank will be cutting interest rates during the financial year, I think this kind of a range is going to stay. Plus, like you rightly say, that the credit offtake is strong, deposit growths have been lagging. So I think there is pressure on the banks, some of the bigger banks, to cut on their investment book, also to bridge the gap between the rising credit demand and the still weak deposit mobilization which is there. So of course, I think the credit offtake numbers the YY numbers are going to come down, because a lot of it was driven by one-off factors. There's frankly no real capex demand. As inflation eases, the inventory funding side of the problem will ease. Second part of the problem was that a lot of the offshore funding was drying up because of the weak currency and the very tight credit conditions globally. And now those things are easing. So I think that access will open up. That will reduce some demand on credit offtake. So I think overall there will be a natural alignment between the credit and deposit growth, but it will take time. I mean, it will take probably 3 to 6 months, but it will happen. And but in this scenario of liquidity tightening and the core liquidity surplus is already down from something like 12 trillion to almost 3 trillion now, and plus it is coming down. We know that in April there will be some more outflows in the form of the TLTRO liquidity going back. So I think take everything taken together, liquidity is tightening, and that is surely going to weigh on the GSEC demand going forward.
You already preempted my question for what your expectation on the MPC next week is, but you also suggested that that could be the last rate hike of this cycle. Considering we still don't have visibility on where the Fed could stop, do you think the RBI will be able to also move on the stance, or they could surprise by holding back on the stance for now and allowing for a pause later in April or something?
So I think RBI will hike and they will retain the stance as still withdrawal of accommodation. I mean, and why I say that is because I think RBI has now linked the stance of withdrawal of accommodation also to the liquidity conditions. And we know that the liquidity still is in surplus mode. It has not been, completely neutralized, and it's not come to, the levels where RBI would ultimately want it to be. So as long as there is surplus liquidity, as long as real rates are still in the vicinity of 125 basis point, I think they will still want to categorize the stance as withdrawal of accommodation. But I think the positive news is on the Fed, which is where at least my view is that probably this is the last hike, or with what happened yesterday, or we might get at best one more hike from the Fed. I think the data is rolling over very sharply. We know that when the inflation prints were going up, again, I mean, the move up was very sharp and very quick, and I think the data is rolling over very quickly as far as the US inflation is concerned. And I think although the Fed did say that in the dot plots they're still looking at 2 rate hikes, but I think eventually we won't get them, and Fed will pause because the data is rolling over very quickly. In the next 2 prints, even the unemployment data might start rolling over. That's the only missing piece. Frankly, inflation is rolling over fast, but Fed has been worried about the labor market and saying that if labor market is tight, then wage pressure will be there, and that will still keep some of the inflation high. Because the goods inflation is coming down because that's linked to the supply chains, and supply chains are easing. We know that goods inflation month on month has been falling now in US. The shelters inflation, which is almost 1/3 of the overall CPI basket in US, that has remained high, but that is a lagging indicator. We know that rents are already coming down, but because the way the rent is computed, it is based on the previous agreement. So if someone had an agreement 3 years back, obviously the rents are going up. But on a month-on-month basis, they are coming down. So there is a broad expectation that 3 to 6 months down the line, even the shelters inflation will roll over. But the third part of the inflation, which is services, services X shelters or X housing, that is the part which the Fed is worried about, and that is linked to the wage market, to the labor market. And I think the labor market is also rolling over. There are clear signs that we over the next 2-3 months we'll see that rolling over, and that kind of will help RBI also to breathe a little easier, because if the Fed is stopping here, I think beyond 6.5, RBI doesn't need to take the repo rate.
This has been extremely illuminating. Thank you for taking out this much time to speak to us on the budget and MPC and what we can expect from interest rates and the Fed in the coming year. Thank you so much, Shailendra sir, for talking to us. Thank you on behalf of BQ Prime and the rest of the team. Thank you.
Thanks for having me. Thanks.